By the closing bell, the Dow Jones Industrial Average was in the steepest fall in its 103-year history, down more than 500 points.
The primary purpose of investing is and has always been to make a handsome return. That is the heartbeat of the enterprise, the rhythm that drives both the humble saver and the seasoned financier. But while the purpose is simple, the path is anything but. For decades, the world of investing has been split between two camps. One claims the market is a flawless oracle, pricing every security with divine accuracy, leaving no room for profit beyond sheer luck. The other, smaller, quieter, but infinitely more dangerous to the efficient market creed, points to a handful of investors who have defied that orthodoxy year after year for decades. They are not magicians, nor gamblers blessed by fortune's fickle smile. They are men who learned in a small intellectual village called Graham and Doddsville, a place not of brick and mortar, but of ideas. Here, the law was simple. Find the difference between the value of a business and the price the market demands for its shares, and act on it. It was not about timing, astrology charts, or the mysterious pull of quarterly earnings whispers. It was about price and value, nothing more, nothing less. Picture the intellectual battlefield they've walked onto. A stock market swayed by herds of emotion, by the most frightened seller and the most greedy buyer, prices bending and snapping under the weight of irrational sentiment. In that chaos, these investors hunted calmly, like wolves moving through the snow, eyes fixed only on the slowest, fattest prey. The story begins with a metaphor, and a mischievous one at that, a national coin-flipping contest. Picture 225 million Americans, every man, woman and child, all rising at dawn and flipping a coin for a single dollar. Call it right, and you double your stake. Call it wrong, and you're out. Each day, the losers disappear, the winners press forward, rolling their winnings into the next flip. By the 10th day, about 220,000 people remain, each clutching over $1,000. By the 20th day, only 215 remain, each with over $1 million. The crowd marvels, the professors scoff. At this point, a skeptical academic will clear his throat and point out the obvious. If 225 million orangutans had been flipping coins for 20 days, the mathematics of chance would have produced the same result. 215 chest-thumping orangutans, each with a perfect streak, each convinced of their genius. Pure probability predicts that even in a game of total chance, some streaks will happen. If enough people play, someone will inevitably flip 20 heads in a row, not because they are skilled, but because the math says it's bound to occur eventually. This is the heart of the efficient market defense. Every winner is just a statistical accident, no different from the lottery player whose number happened to come up. But then, the twist. 40 of these improbable winners all came from the same small zoo in Omaha. Now, the odds shift. The pattern changes. This is no longer just randomness doing its lazy work. In probability, independent streaks scattered across a huge population tell you nothing special, but a concentrated cluster of winners from the same place demands explanation. Something else is happening. The orangutans are not flipping coins like everyone else. Think of it like looking up at the night sky. If you saw bright stars spread evenly across the heavens, you might think nothing of it. That's the natural scatter of chance. But if you suddenly saw a brilliant, dense cluster in one small corner, you would know there's a gravitational force at work. That cluster is telling you there's a real structure, a shared origin, an invisible rule pulling them together. This is why the metaphor matters. It forces us to ask the investigative questions that separate luck from method. What are they being fed? How do they practice? Who trained them? The coin flip contest strips away excuses and lets you see the statistical bones of the problem. If skill plays no role, winners should be randomly scattered, like those evenly spaced stars. But if you find a dense constellation in one tiny patch, you have discovered a force that cannot be explained away by luck alone. That is the essence of Graham and Doddsville, a place, not geographic but intellectual, where investors learn the same philosophy, apply it independently, and still outperform for decades. The zoo in Omaha is real, and the orangutans are humans who have learned to stop flipping coins and start weighing businesses. The zookeeper's name, in this case, was Benjamin Graham. His protégés did not parrot his traits. They internalized his philosophy, then went their own way. Before following them down the corridor, it helps to step into the bright, humming laboratory where their chief antagonist set up his instruments. It is called the efficient market hypothesis. At first glance, it looks clinical and reassuring. Prices, the theory says, already contain everything that matters. Every balance sheet line, every whisper from the factory floor, every macroeconomic tremor, If all known information is baked into the tag on the stock, then the tag is truth. There are no bargains, there are only illusions and luck. The idea did not spring from nowhere. Its taproot reaches back to the year 1900, when a French mathematician named Louis Bachelier wrote a thesis arguing that price changes in speculative markets behave like a random walk. By random walk, he meant that future price movements cannot be predicted from past price movements in any reliable way. Picture a drunkard leaving a pub at midnight, stumbling along the pavement. Each step he takes is random, left, right, forward, with no pattern you could use to predict where he will end up. In finance, the random walk idea says stock prices behave the same way. Today's change tells you nothing about tomorrow's. If yesterday's price went up, it does not mean today's will rise or fall. Each movement is independent, shaped by new information arriving in unpredictable bursts. The implication is sobering. If this is true, then studying charts or past data is no better than trying to guess the next step of that staggering man in the dark. Decades later, the notion resurfaced in the 1960s as economists sharpened it into doctrine. Paul Samuelson offered a rigorous argument that properly anticipated prices should follow a martingale. A martingale is a mathematical model for a sequence of values. Like stock prices, where the best prediction for tomorrow's price is simply today's price. It means there's no built-in drift upward or downward once all known information is accounted for. Think of it as walking on a flat, endless plain in thick fog. Your best guess for where you will be in the next step is exactly where you are now. In the context of markets, the martingale idea says that prices already incorporate all available information, so any future movement will be purely the result of random new information, nothing you can predict in advance. Eugene Farmer, first in a 1965 dissertation and then in a landmark review in 1970, organized the belief system and handed it a name. From those papers came three tidy forms. The weak form said that past prices are useless for prediction. The semi-strong form said that all publicly available information is already reflected in the price. The strong form said that even private information cannot produce a persistent edge. It was an elegant cathedral built from statistics and hope. In that cathedral, the investor is a passenger strapped into the back seat while the market drives. Performance that beats the broad index for a stretch is filed under survivor's luck, like a handful of coin flippers standing at the end of a long hallway after millions have dropped out. The story ends there. The flippers preen, the professors shrug, the verdict is randomness. But the real market is not a cathedral. It is a crowded fairground at night, lit by strings of flickering bulbs, echoing with shouts, laughter, and the occasional cry of panic. Prices are set not by some omniscient benevolent force, but at the ragged edge of the crowd by the most anxious seller and the most ravenous buyer. This is not an arena of angels or an idealized race of perfectly rational beings. It is a marketplace of humans. Humans with rent due, with children to feed, with egos to protect, with bonuses to chase, with mistakes to hide. The efficient market hypothesis imagines a place that doesn't exist. A kind of alien utopia where every participant has perfect self-control, perfect knowledge, and no personal agenda. In that imagined marketplace, each trader is like a serene extraterrestrial mathematician, calmly computing the exact value of a company with no bias, no fatigue, no overreaction. Prices in such a world would glide into place like precision machined gears. But the stock market we actually have is not inhabited by such beings. It is inhabited by us. News does not settle into prices like a gentle snowfall, covering everything in a thin, even layer. It slams, it ricochets. It gets misread in the rush of the moment, ignored by those distracted, exaggerated by those with something to gain. The market is a conversation where not everyone hears the same words, and where some shout while others mumble. Information does not arrive evenly or get processed cleanly, because human beings do not think evenly or process cleanly. We leap to conclusions, we anchor on the first number we see. We cling to comforting stories long after the facts have changed. We act in groups, moving with the herd, even when we know the herd is heading for the cliff. Fear arrives faster than footnotes, and once fear spreads, it doesn't politely check in with valuation models before it acts. Greed speaks louder than footnotes, and when greed takes hold, it drives people to pay more than they should because they believe someone else will pay even more. These are the creatures setting prices. Fallible, impulsive, overconfident, sometimes brilliant, often wrong. And they do it every day, all day, in every corner of the market.
So, what does this all mean? The efficient market hypothesis tells us that no one can win consistently, that every streak is just luck. But the evidence from Graham and Doddsville tells a different story. It tells us that when 40 coin flippers from the same intellectual zoo keep winning decade after decade, it is no longer chance, it is method. The method is value investing, buying businesses, not tickers, weighing, not voting, demanding a margin of safety instead of chasing the noise. It is simple, but not easy. And while most investors rush after glamour and momentum, a small group keeps patiently scooping up dollar bills for 40 cents. The market will always be a fairground of fear and greed. Prices will always swing wider than reason. And as long as humans are the ones flipping the coins, there will always be opportunities for those trained in Graham's village to step forward and profit. So here's the question I leave you with. Are you content to keep flipping coins with the crowd, hoping for luck? Or will you walk down the narrow road to Graham and Doddsville, where reason still beats randomness? If you found this story compelling, let me know what you think in the comments. And don't forget to subscribe for more investigations into the myths, the methods, and the mysteries of finance.